Hey, this is Caleb Block with HomeSmart, and I'm here with my friend Dale Seaman with Finance of America. And we were going to discuss what we've been seeing recently in the real estate market with the rising interest levels. Dale, obviously, you're seeing quite a bit of a change in your neck of the woods, just as far as loan applications, that kind of thing. So, do you want to kind of discuss like where we were at the beginning of the year versus where we are now at the end of July?
Yeah, absolutely. And good to see you again, Caleb. Good to chat here for a few minutes.
Sure.
Basically, yeah, I mean, refinances have dropped to about 30% of the mortgage market, as well as purchases have, dropped about 20% over last year. So, obviously that's a significant change. I wouldn't necessarily say remember that's comparing it to 2021. Those numbers aren't really that bad if we start looking back to 17, 18, and 19, which is a little bit more of a normal, the real estate market's been strong since, let's say, 2012, 2015,
Right.
at least 2015 coming forward. So, looking back in history, it's, not as bad as what a lot of the media always tries to make it out using the numbers to be dramatic. But as far as the beginning of the year, general 30-year rates, have gone from like 2.75 at the low, maybe 3, up to 5.5, 6, even depending on a borrower's situation. Remember, rates take into a lot of factors, credit scores, especially on conventional loans, are a huge impact. Loan to values, debt ratios, there's a lot of factors that go into somebody's rate. So I'll say, somebody's rate could be anywhere from 5.5 to 7, just kind of depending on what they have going on.
Sure.
But, and a lot of the rates that you see publicized, remember like those lower rates, like the last week or so, Freddie Mac, some of the rates they publish as far as averages between like 5.5 and 6, that person's probably paying 1 percentage point in order to buy down that rate sum.
Right.
versus somebody that's getting what's called a par rate, where there is no, they're not getting any credit or any debit on that rate.
Sure. So yeah, and have you just seen a general slowdown in the new applications you're getting in, that kind of thing, or?
Oh yeah, definitely. Things are currently shifting.
Yeah.
For sure. I'm not sure. I don't necessarily look at that as a bad thing. Our market the last year or two has just been like almost stupidity between the real estate market, and it's just not sustainable. It's not healthy.
Right.
So I think the shift that we're seeing is actually a good thing overall, and it'll help the real estate market and the mortgage market to stay stronger. But that shift is painful in some ways. Part of that pain is because there's a lot of volatility in the market right now when it comes to mortgage rates, which makes it hard for buyers and people to make decisions, as well as it makes it hard for companies to navigate doing business. And what are the rates? The stuff's changing every day. It's all over the place. So really what we need is that stability to come back to the market, which the beginning of the year was fine, but in March that instability started. Yeah. So we've been dealing with that now for March, April, May, June, July, almost 5 months. But it does look like things are starting to stabilize out, which should be good for the market. I'm thinking that rates have probably topped out on the high end. We'll wait and see what happens for sure, but a lot of the indicators are pointing that direction. As the Fed increases the Fed rate, which let's see here, about
say,
2 hours ago, the Fed made an announcement that they're raising the Fed rate another 0.75 of a point, 0.75. That doesn't necessarily affect or translate to mortgage rates. That rate that they're adjusting is the Fed. Basically, it's an overnight rate between banks that they use, and there's a lot of history that shows that, as it's actually that Fed rate going into place, trying to
curb inflation,
basically slow down the inflation situation, which is why part of the reason why rates are going out of control, should bring mortgage rates back into back into place, and actually mortgage rates will probably go down over the coming months, to a year.
Interesting. Yeah. So you don't think so? Just general inflation in the economy doesn't necessarily translate to mortgage rates either. Then.
Well, the higher the inflation correlates, because as inflation generally goes up, it's volatility, and that can drive up mortgage rates.
Okay.
Because think about it as if somebody's investing, if inflation's at over 9%, which it is right now, if you've got a mortgage that you're lending money on at 5%, I mean, you're losing 4% per year.
Sure. Yeah, makes sense.
So if that continues, it's a problem. But what the Fed's trying to do is, by jacking these rates up, they've forecasted being at like 3.0 to 3.5 by the end of the year, to bring that inflation under control, which is historically has always worked in the past. The downside is it will push us into a recession, most likely. I mean, they'll talk about soft landings and stuff, but generally that hasn't seemed to happen. Though, I mean, recession is also kind of like a big bad word that, it can be bad, but it's not necessarily, I think we perceive it worse than it is a lot of times.
Definitely. And I mean, yeah, we're definitely on the realtor side seeing there's definitely a lot less showings. I'm starting to see open house signs popping up here and there, which we didn't see back in last year and even the spring, just because every home was getting multiple offers on it. You didn't really even have time to do an open house.
Right.
But, some of my colleagues have been, and I know you can see those posts on Facebook as well. People are wondering, they've been sitting on the market for over a week with no showings in some cases. But then again, you never know what the condition of each house is until you take a look at it. So,
right. I think, I think a lot of that will stabilize out. The other thing is we're kind of in this period in July, middle, it changes some years, but it seems like in the past, middle of July to the end of July, sometimes we get into this period that's like, just kind of like, all of a sudden everything comes to a standstill for a couple of weeks.
I've always kind of noticed a summer slump as well. I don't know if it correlates to people being on vacation or just could be several factors, but I've always noticed in the summertime, maybe between like July and August before school gets back in.
I think that's it. I mean, it makes sense because all the schools starting, let's say, around this area, maybe between the 10th and the 15th of August, and everybody's like, all of a sudden realize maybe they didn't get the stuff they did the family stuff or the vacations in June, and they're scrambling to get some time in this summer before school starts. So I mean, I'm sure that's a big impact of it. It seems to float around a little bit every year, though. I mean, sometimes it could be from the end of June, middle of June occasionally, but it seems like a lot of times it's that 2-week period that we're in right now. So, I mean, that's probably not all of what the agents are seeing, but it's some of it. I mean, a big impact is also obviously the rates, and, this is a big change for people. Basically, rates almost doubling for a little while. And, obviously that knocks, a certain number of people out of the market as far as qualifying or being able to qualify. But, there are still people that can afford it. And I would say, for those that have been, like sitting on the sidelines because they couldn't get a property under contract, this could, although the rates are a downside, this could be the exact opportunity that they need. Competition will be lower. They get something under contract. The payment may be a little higher than they would hope for right now because of rates, but I think there's a very good chance that rates will decline in the next, within the next 12 months. Sure. Hopefully, maybe, or at least 18 months or so.
Right. And you did provide me a couple charts. If you'd like to look at them, I can put you on a screen share real quick.
Sure. Let's go ahead and do that.
These would be interesting for folks to check out. Let's see. All right. Can you see that on it?
Though, let's click into, let's see, where are we here?
That Fed graph, Fed's rate history.
Yeah, let's go ahead and click into that third one there.
Okay.
Yeah. So, but basically what this chart is showing is it's basically a historical chart. Do you think the viewers will go ahead and keep it there? I think is the best view.
Mouse wheel.
Right. Basically, the blue line is the Fed funds rate, the rate that the Fed raised by 3/4 today. And you can see it over on the far right there, but it goes back all the way to 1955 through today. And then starting in the early 70s, you can see this information is from Freddie Mac, so it's conventional loans, and their average doesn't include the Fannie stuff, but it's all kind of tracks closely together. The red line is the interest rates. So you can see where the Fed rate, so, I mean, let's go back to the mid 70s there. You can see where the Fed rate was between 2.5 and 5. The Fed rate went way, way up, but interest rates didn't increase didn't increase in the same manner for quite a while. They did go up some. And if we come more current, I mean, we can go back to 2010 and kind of see how they, before 2010, you can see how they dramatically dropped the Fed rate. And then it's slow, mortgage rates much slower started to come down, correct? And the other thing is that the gray bars here are recession periods, and in the vertical there.
Sure.
Like, before 2010. That's kind of interesting because if you look at every recession period, even though prior to that, most of them, the Fed was hiking rates. Like, let's say in 2005, the Fed hiked rates, mortgage rates, stayed somewhat stable, and then they started coming down during the recession. So
yeah, it's interesting to see that Fed rate and just see how low it's been, since 2008, really.
Yeah, basically they hadn't raised it until 2015. And this is kind of an exact, like, my experience in 2015 was very interesting because at the end of the year, I had a handful of clients, the Fed was going to start raising that Fed rate. Right. So I had a handful of clients that started rushing, November, December to get houses purchased. Those people that purchased in December, I ended up refinancing them the next summer because the Fed made some rate increases and it actually dropped the mortgage rates enough that it was beneficial for them to do a refinance.
Sure. Now that is interesting to see the correlation on those. So, but yeah, I mean, historically, really since the 80s, mortgage rates have pretty much been on a downward trend. They're just now spiking up a little bit back to
right.
5, but.
And if you follow that back where you had your thing, where you had your arrow, if you start going back in time, I mean, that rate basically takes us back to, about that 2008, 2009 period, right?
Right. And it looks like, yeah, historically prior to that, it was always higher.
Right. Because then, prior to 2008, let's say we were at 6 plus or minus. 2009, we dropped to, we had a little bit of we had a refi boom, dropping us to like 5%. And then a couple of years later, everything dropped to 4, and plus or minus, we kind of been floating we'd kind of been floating between 3.75 and 4.5 or something,
sure.
Ever since like 2011 or 2012.
And I think this is important for buyers to take a look at and just see, especially historically, like things have been a lot higher. Do you know what happened in the 80s to make that peak mortgage rate?
Basically, it was inflation.
Okay.
I mean, inflation was way out of control, and there's a whole other story there that we can go into, and probably not at this time, but we could, cover that at a different time. It's kind of a neat story around the different Fed chairs at the time.
Okay.
And what they did in each of those periods, and kind of what it resulted in as far as interest rate drops, and also what it did to the stock market.
Sure. Well, excellent. I mean, that was a good chart to look at. I don't know if you want to take a peek at any of these other ones.
Yeah, why don't we pull up the other ones that I sent over to you? What we have there. I think that's just a PDF, and you can probably. Okay, so real quick here, this one here, one of the indicators that they use for recession is basically the treasury yield curve. I mean, generally, a 10-year minus 2-year rate should be positive, which is all the green you see.
Sure.
When the 10-year minus the 2-year is a negative number, like you see back in the 80s.
Yeah, see that's in the red. Yep. Mm-hmm.
Right. And then you can see it at other times here. It's always coming right before a recession. And you can actually see that we were actually pending possibly going into recession right before COVID in early, late 2019.
Yeah, it looks like there's a little dip into the red there, right there.
Right, there's a little dip, and then you can see this tiny recession. We barely felt this, we barely felt that at the time, because it was late 2019, January, February. It might have been starting. If COVID hadn't happened, we might have had a totally different experience there. But with all the, with COVID overshadowing everything and taking and all the measures that were put in place around it, I think it just kind of drained it out. But you can see where that curve is going negative here recently also.
Sure. Yeah, it's starting to dip in there twice, and
which is one of the indicators of a recession, possibly. It just depends on, is a recession really a big deal? It depends on how deep it is, right?
Sure.
And how much of an impact it has, and we really don't know that yet. One of the other indicators would be like right now, unemployment's still at a really low number. If that unemployment started to turn up, then that would be another indicator that we're that we're either in a recession or that it's on its way.
Right.
So, but if you go to that PDF that was with that email,
yes.
Let's go into that for a minute and just look at a couple of those
Sure.
charts, because this explains it a little bit more. So here it's kind of showing the recession periods like what we just talked about. So I've kind of already covered that. Let's go ahead and go to the next slide. But this shows you over time what recessions have done to mortgage rates. So as the Fed raises that rate, most of the time, they try not to, but haven't been very successful at it. Most of the time it does push us in a recession, which then ends up bringing rates down. Like I won't go too far back in history because that's not totally relevant to most of us in today's world. But, you can see back in 2002 where we went from 7.375 to 6.75. 2008-9 we went from 6, in 2008 we dropped down to 4.875 and 9, and then during the small recession / COVID there, we went from 3.75 down to 2.75. Just kind of
that's actually very interesting that times of recession pushed the mortgage rates down, but
right.
I think the average person would assume they would be going up in that time, but
right. But one of the things there that's interesting is, when a recession, generally the stock market takes a hit too. I think we're at about 20% now, so we could already be there when they run the numbers in the recession, but it could be 20%, 30%. There's been recessions that were 50%.
Right. Certainly.
So one of the things that happens there is a lot of that money comes out of the stock market. Well, has to go somewhere. Most people don't want to just sit there in cash for very long. So a lot of times what that does is it comes into the bond market, and with a lot more supply of buyers in the bond market, it actually drops those interest rates because they can offer less of an interest rate for those buyers. Okay. So go ahead to the next chart, though, is really interesting around recessions, though, in real estate. This shows the same recession bars that we were looking at earlier.
Sure.
And this is this is national, but it's based on the house price index. You can see in every recession other than one here, this is good news for real estate, right? Every recession other than one, which is the 08-09, real estate prices have,
continued to
not only maintained, but increased some during recessions.
Yeah, that is fascinating because I think there are a lot of people that kind of want to bank on the idea that it'll be similar to 2008 where the housing market will just kind of implode. But like you said, historically, maybe back here in 1960 it was kind of level, but pretty much every other recession on this chart, everything is gaining in value still.
Right. So if we're scared about recessions, it's really kind of irrational or doesn't make sense because, as long as it maintains or the losses are very small, there really isn't much to worry about in the real estate market. And 08-09 was very different. And part of the big reason it was different was it was the housing market that pulled us into the recession.
Right. Because
where right now, this is something else we could cover, but inventories have increased some, but I think that's a good thing because our market was very unhealthy. as far as the amount of inventory available. And as you know, right now, it's very different than 08, 09 because we have, I mean, the inventories in 08, 09 were massive, but versus now, inventories are very low. There's still a very strong demand.
Oh, certainly.
So,
Yeah.
I mean, the scenario looks totally different.
Right. Well, and I think that's a good thing for both buyers and sellers to keep in mind. Maybe from the seller perspective, they might have to be doing a little bit more to make the curb appeal perhaps a little bit better, or,
Well, come on, sellers, let's not get greedy here. I don't know that you need 10 offers to sell your house,
Well, and I still
20.
think making sure you're competitive in your pricing is always important.
Right. Good pricing, a property that shows well. I mean, 80-90% of the buyers want all the pretty ones, right?
Oh, absolutely.
I mean, I had 2 buyers last weekend lose out on contracts because they were second. And at least, I mean, I didn't see the houses, but online the houses look beautiful.
Sure.
So I think it's those beautiful houses that are getting all the attention right now, and still getting many, multiple offers.
Right.
So I think, I think it's just getting back to the way the real estate market used to be, or should be, where, the things are a little more balanced between buyers and sellers, and the seller could still even most likely have the advantage in this day. It's just, that we've kind of been sellers, have probably just been kind of spoiled over the last couple of years.
They've been very spoiled over the last couple of years.
Right. So.
I mean, it's interesting, and I think educating sellers, especially that, hey, you might not be getting those 10 offers now. The pool of buyers has definitely shrank just because of those interest rates, and but that doesn't mean there aren't buyers out there looking. Certainly, I mean, I think Denver is going to remain a pretty hot market.
Mm-hmm. And and there are some, because there's some things we're working on right now within our company to actually help sellers, and some of that stuff will be finalizing here shortly. But I mean, a seller can, depending on how many offers they have, of course, if they're working with one buyer, the way things are a lot of times, in the past, and trying to get a deal done, the buyer wants to buy, the seller wants to sell. There are things out there that the seller can help with financing wise, like we can get back to the, first time home buyers being able to have an opportunity with some seller concessions to help them pay closing costs.
Right.
So they can use the money they have available towards down payment. There's options where, in order to help a buyer get a payment down, a seller, instead of lowering, let's say, purchase price, maybe 20 grand, maybe they could help with 5 or 10 grand to help a buyer pay down a rate.
Sure. Yep. Give them a couple points. Yeah.
Mm-hmm. To do things like that, just kind of, every scenario is, really specific to the.
Yeah, and I would say, at least when I started doing real estate, I think those things were a little bit more common. But yeah, in the last couple of years, asking for concessions hasn't seemed to be like a winning strategy.
Well, definitely not the last couple of years, but it seems like it may be coming back into play somehow.
I'm sure it will be, yeah. And I think sellers are going to have to be a little bit more flexible with, they're going to have to play ball a little bit more.
Right.
So
I don't know. I mean, with a seller pay and seller concessions, we can potentially get a buyer in a house with, very little down, maybe $1,000 or even earnest money. If it's a $500,000 purchase, maybe 4 or 5 grand.
Right.
If they're paying, combining the seller concessions with down payment assistance programs. And I mean, yeah, some people look at that and say that's a negative, but everybody's got to live somewhere.
That's right.
Yeah. And usually somebody, they're out of the market now, and first time home buyers have been extremely hurt this last couple of years.
Yeah.
And sometimes the only way prices are going up more than they can save. So,
right. So yeah, finding creative ways to get buyers into those homes is
if it's
important.
I mean, somebody buying a house can set them up for their future.
Right.
Totally change their life as
Yep.
far as being able to, accumulate an asset, own something versus living month to month in an apartment or something.
Right. Well, that's why we do what we do, right?
Absolutely. It's fun. That's what makes it good. Helping people out.
Yeah, of course, man. Well, I think that was a really good explanation of kind of what's going on. I don't know if you wanted to add anything else to that or.
I think I covered most of what, kind of the direction we went with this conversation, but I don't know, is there anything that you would like to add or any question, anything you think we kind of skipped over a little bit that could use a little more depth either on your side or my side or?
Well, and I'm wondering if I can pull up the month inventory. Looks like the median days on the market in Denver's gotten up to 34, it looks like, according to realtor.com.
How many did you say?
34, it's what it's saying.
Really? Okay.
Which,
Now, does that day on market, does that include the contract period or not? I don't recall.
I'm not sure as far as realtor.com goes. I would say probably looking back into June of last year, that probably includes the escrow period. I'll have to take a look though to make sure. Okay. Let's see. It says that in Denver proper, there's currently just 2,881 homes for sale. So it's still pretty low inventory as far as it goes, but yeah.
But it has increased over the last few months.
Absolutely. Yeah. I don't know, Dale. I think from a real estate perspective, I guess I would just say to buyers, maybe like you said, maybe today, right now is a good opportunity. Even though the rates are going up, maybe the competition, maybe it's scaring other people out of the market. You might have a better shot and less competing offers.
Well, yeah, I think mentally, definitely, I would say for sure, people are mentally trying to adjust to this rate change and payment change.
Right.
And that is definitely going to move people either out of the market because they don't qualify anymore, unfortunately, or move them out of the market because mentally they're just like, I'm not going to pay 6%.
Right.
I think though, for those that want to own a home and have been trying to get into the market and haven't been able to, I think it's a huge opportunity because, prices probably won't continue to appreciate the way they were, but with the demand, I don't know that they're really going to decrease. I mean, we're seeing like price decreases on listings, but I don't think we're really seeing a decrease in value.
Sure.
And that's, so for these buyers that have been sitting on the sidelines, I would encourage you to, get back, re-engage and be positive and get back out there, see what you can do. Take a look at the numbers. Yeah, you got to be okay with your payment today, but I think there's a very good chance you'll be able to refinance and lower that payment in the next year or two.
Sure. And I think like I said, sharing those charts really, that does kind of shed some light on everything. So I think, yeah, just as a buyer, even though it has technically doubled the interest rate, don't freak out about it just yet.
Right. I mean, it is what it is. This is still historically pretty low rates overall. It's, where we were for years. And, but I mean, who knows where we'll settle? Maybe we'll drop back down to 5. Maybe we'll drop back down to 4, 4 or 5, somewhere in there over the next time period here. But I mean, I'd say it's very unlikely that we're going to go back to that, 3.
Right. Okay. Well, yeah, I think that pretty much sums it up as far as answering some basic questions about what's going on with those rates. So I think we're about to run out of time here on the meeting. So
okay.
Thanks for showing me all that. And that was educational for me as well. So I appreciate that.
Okay, great. Yeah, Caleb, keep in touch and let me know what you need. And anybody else listening to this video, both myself and Caleb would love to chat with you if you have any other additional questions.
Yeah, absolutely. And Dale's info will be down in the description box. So I will have that. And yeah, we'll do another video soon. So good to see you, man. And thanks for talking.
You too. Have a great one. Bye-bye.
See ya.